Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Hello, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to Geoff Gannon. Geoff, do the intro. How's it going today?
It's going very well. How is it going with you?
It's going well. No, you take over this podcast. Yeah, you take it over because you take the computer because this is what we're doing. We're talking today. You tell them what we're doing. What are we doing?
All right, we're going to talk about what things stocks you bring to me to write up and why. So on the website, focuscompounding.com.
Yep. Okay. Go ahead.
This is promoting the website.
All right, go ahead. Okay. Thank you.
On the website, focuscompounding.com, I do a bunch of write-ups. They're usually around 2,000 words. Sometimes they're longer. They're longer, but I try to aim for 2,000. They end up being 3,000 usually. So, but you bring those ideas to me, what to write up. At the end of the day, I look in my email, and there's something there telling me what to write up.
Correct.
And we have a list here of some of the recent ones. The last, we have a lot here, so we'll go over that. So we want to talk about why you pick the ones you do.
Sure.
Specifically, maybe why you pick those specific stocks sometimes, but also just generally what you're looking for.
Okay.
So generally, what are you looking for? Are you running a screen? How are you doing it?
Yeah, so the first thing I usually do, pull up Quick FS too. You're running the ship today.
You can do that. I'm not a technology person.
Oh, come on. All right, okay.
You've seen me use a phone.
Yes, let's see. All right, so we'll pull up Quick FS, type in... Okay, we'll use the ones that we're talking about. Vitreous glass. Okay, So the first thing I look for is obviously we screen for companies, which I hate, kind of, because...
you hate the screening, not the companies.
Yeah. The screening sometimes could be a bit of a pain because, A, you're looking at a lot of the same companies. A lot of the screens that we look for, it's a lot of trust and like stuff that we would not be interested in. Okay. I know pretty quickly if it's a business that we'd be interested in. Geoff and I were actually just talking about this. Were we talking about on the podcast? I can't remember. But how you just know pretty much. Oh, yeah, it was an intuition question. Somebody asked us on the podcast, like how much of it, the ideas you pursue is intuition or even invest in intuition as opposed to whatever. And I was saying that, you could look at 100 different companies and you're still looking at it and you're like, I know relatively quickly that it's something that we would not be interested in. But on the other end of the spectrum, I know just as quickly if it is something that we'd be interested in. And you've spoken about that too in the past, how your process is really knowing within probably 5 minutes, this is a company that you'd really would potentially want to buy. And then you spend the rest of your due diligence really doing a bunch of fact checking and learning a little bit more about it.
Yeah.
So my process is we screen, I look through the companies, I put it in, Quick FS, kind of do a quick and dirty, I guess you could say, on the company. Is this something that we'd be potentially interested in? Now, again, I'll preface this by saying this in itself is probably bad because you can miss out on ideas as well.
You could.
Because, it may not look pretty today, but that doesn't mean that it's not an interesting idea. I mean, we've talked about NACO. I think NACO probably wouldn't have screened as good prior to the spin. I mean, it just would have looked different.
The only reason we were reading about it was because there was a spinoff. It had been written up because it was a spinoff. A lot of people were interested in the other side of it, and then we just read the annual report. That's true for most spinoffs.
Yeah.
It's a spinoff is happening, so we read the 10K.
But, I'm really just looking for companies where I feel, there's not a lot of catastrophic risk, I guess you could say. Geoff and I talk about this a lot. I don't like headline risk when it comes to businesses. Okay. Right. So vitreous glass was a little bit of a different situation. I knew that this would be a business that you would be interested in. The 10-year median margins of gross profit are 45%, looking pretty predictable. The 10-year CAGR on the company is only 1%, but it's trading at an EV to free cash flow of, call it 10 times. So call that a 10% free cash flow yield. If I remember correctly, it has a 4% dividend. I can't remember.
Vitreous glass,
yeah,
I think
vitreous glass.
Quite
is
a bit
more?
higher than
it is
that,
more. Yeah. So
because it pays everything out in dividends.
So there you go. So I was like, okay, this is probably something that was interesting. I remember I read the business description, which they don't have right there. And
it's like it's over 8% dividend yield, I think, when I looked at it.
Yeah. If you look at the return on equity and return on invested capital, is all very high. Low PE. Read the business description, and I knew this was probably it's unique. And this would probably be something that Geoff would be interested in. $21 million market cap. Now that's in Canadian dollars, but so that's like what in US dollars? Kind of.
It's also a micro cap. It's not a big
micro
difference.
cap. Yeah, very small.
And it hasn't return on equity or something. I think hasn't been below about 20% in like 15 years or something.
Yeah,
any of those years. So that would obviously be something to be really interesting. That's really unusual. Yeah,
very predictable. And I can't remember if they have long-term contracts or not. I know they have some sort of contracts. Which
that was part of the issue. Reading about it, about what they really disclosed. But yeah, they have They certainly have long-term relationships on both sides, the supply side and the customer sides. They don't go into much detail about what their actual contract terms are and stuff. It's not like NACA, that one. Yeah.
But really from just reading about it and looking at the numbers, I figured this would be a company that you'd be interested in. So I put that on a list. Really. Okay. I mean, that's kind of the bottom line with it. I didn't get too in-depth on this company as I have on other businesses, but just from reading the business description. I mean, look, the first thing if I read the description, I mean, pretty quickly, and people that invest, I mean, if that's something that you'd be interested in. Like, we've talked about this before. I feel like you're really agnostic towards what type of business that you'd be interested in, kind of from the offset.
I know you say that, yeah.
You don't agree with me on that.
I think that I'm not in terms of the core microeconomics of the business, but in terms of what industry it's in or something, yeah. Because like we'll talk in a second about Stella Jones.
Yeah.
Yeah. And if you had described that business to me at first, I would have said, probably not interested or something. But as soon as you described what they actually do, then I was very interested in it. Sure. Yeah. I mean, a lot of the businesses we invest in have some sort of service component to them, even if they're really a commodity thing.
I mean, we talk about that. I really like service businesses.
Yeah.
I really like, low levered service businesses generate a ton of free cash flow, high customer retention rates, long-term contracts, really finding these businesses that have the least amount of headline risk possible. Okay. Now, the problem is when you're looking at these companies, especially in our world, maybe of smaller companies, even though we don't just own small companies, we own big companies, the customer concentration is incredibly high. Yeah. What?
That's the problem with Vitreous Glass.
Yeah, I was going to say.
Basically, they're making all their money from two customers, whereas with, like you're talking about, and NACO to some extent is making almost all their money from a huge amount of the value of the stock is in two customers, basically. But you compare that to something like computer services or something, which is dealing with a lot of smaller banks, very low customer concentration risk. We've talked about that with consulting companies, usually very low customer concentration risk. Ad agencies, very low customer concentration risk, and a lot of the same economics. So,
And, in a lot of sort of my initial filter processes, you were just talking about you take the stock out of it. Is this something that you would potentially want to buy yourself and be able to hold for the next 10 to 20 years, right? And of course, 20 years is a very long time, but let's be realistic about it. Owning retailer, I'm not sure. I mean, that'd be very tough, right? Who knows where that's going? But a company like computer services, a company like over-the-counter markets, that's a company that companies, in my opinion, where it's virtually certain that you could just close your eyes and feel pretty safe about the actual business going forward with it,
Yeah. And with Vitreous Glass, if someone came and knocked on our door and said, look, I want to sell this plant in Alberta that has this deal to recycle all the glass there and turn it into an input for fiberglass insulation stuff for these customers, we would hear them out. Yeah. That's what I mean. That's really the way of thinking about it is, that would be an interesting business proposition to buy the whole thing. And so if we'd really consider buying the whole thing, if someone came up to you as a private company, then that's why we would consider buying it as a public company, as a stock,
Yeah. But yeah, I was pretty interested. I knew you would be very interested in it. Now, when I did say a lot of the companies that we do focus on have high customer concentration, that's kind of me contradicting myself because I said I like to stay away from businesses where they have massive headline risk.
Yeah.
And I would argue that companies that have very few customers, that's a form of headline risk, I would say, for sure.
I think a lot of people avoid them. I think people are very cautious about high customer concentration.
Yeah, and that's something that has always worried me about, Now, you could sort of mitigate that by contracts and stuff like that, long-term contracts and everything. But, of course, that's something that's obviously in the back of my mind when looking at these companies. Yeah.
Yeah, and I tend to see customer concentration risk more as not headline risk, but bargaining power issues. I think we mentioned, what was it, Crown Crafts? The company that Walmart is a very big customer of them for baby stuff. That kind of thing worries me more. Not that Walmart's going to stop buying from them at all, but that Walmart probably has a lot of power in that relationship and stuff like that. So when I look at any of these companies, I'm thinking, well, what's the real relationship in terms of negotiations that you'd have between Vitreous Glass and these customers and things like that?
Yeah.
Rather than just how much concentration is there, how much bargaining power is there?
Sure.
Yeah.
But yeah, I don't really have anything else to say about this company. Do you have any
Okay.
questions on it?
No, that's good. So let's look at some of the other ones that we have.
So this is called a Surface.
Okay.
And you can touch it. So if you
All right.
it's touchscreen, and then whoa, you can go like this too to find ideas.
What do I work on every day?
Technology is awesome. Jeff works on a Surface. Okay, next company, go for it.
So Points International?
Capital 8. That was the first thing that stood out to me.
Canadian, you'll pick only Canadians.
Apparently, I don't know what's been going on lately. Apparently, we gotta change our our screens.
You don't
a little
sort
bit.
out the country thing not to show
No.
non-only U.S. companies.
No.
So if you run a screen with not only U.S. companies, then that would happen.
Yeah, but I thought it was interesting. 10-year CAGR was very high. I'm looking right now, 17%. PE is 17, right? But that doesn't. I mean, for a very capital light, high free cash flow generative business, that doesn't mean. I mean, it could be cheap. EV to free cash flow was 7 times, which of course that's probably what stood out to me most. I think they do pay a dividend. I don't know. I don't remember right now. But the numbers just looked pretty good, pretty predictable. And then actually, when you read the business description of what they do.
They try very hard not to reveal what they do.
Yeah, they do. It says provides e-commerce and technology services to loyalty program operators in the United States. So think like airlines, hotels, etc. And I haven't heard of a business that does that, quite honestly.
Okay.
That manages that part of the business. And obviously, customer loyalty points and everything is a massive part of the travel agency, airlines, hotels. I thought it was a unique niche. Haven't heard of companies that do that in the past. So I was really just intrigued to learn about the business itself.
Yeah.
Not even from an investing standpoint, but from looking at the numbers, like I said, 8 times EV to free cash flow, high growth. I thought it was interesting. If you read the investor presentation on the business itself, management's they're betting on some significant growth. And if they're able to hit that growth, it's incredibly cheap. It's kind of like the Monish Pabrai's way that he kind of goes about it, right? With respect to him, in the example that he used for Fiat Chrysler, I think was where if he talked about if management hits their expectations, the company's cheap, blah, blah, blah. He made a ton of money. So good investment, Monish. But I just thought it was a very interesting idea. I really did.
And you had read the investor presentation early on?
Read the investor presentation.
So they give like 3-year out guidance basically, or a target.
It was like
2022
or something.
Yeah, and it's a number that would mean the stock is very cheap versus what it'll be earning in 3 years.
Yes, and what some investors, that's how, if you read a lot of write-ups on Value Investors Club, a lot of people do that. They say, I think it could do this by 2022, and if so, it's trading 5 times that number, right? The way Buffett always talks about is he wants a 15% return today, right? That he feels like is going to grow, right? Or 10 or 15. Yeah. So I think we tend to think in that regard as well. So I think that's sort of what's different about the way that we do things than what other investors do things. But so 8 times EV to free cash flow, what's that free cash flow yield? I mean, it's up
12.
there, 12.
Yeah.
And then they have, I can't remember. I think they pay a dividend, but I don't remember right now. Naturally I was interested. I was just really interested in the business.
I think they do because they've been buying back 4% or 5%.
Okay, good. Every year. Yeah, and I did notice that as well, which I don't think I have that down here.
But that's a big thing for me. Seeing a company start to buy back a lot of their stock is very interesting. It's funny that you suggested this stock to me though, because you know how little I like management's predictions about things.
Yeah.
They have 3-year projections.
They're very bullish, I will say.
Yeah. They have 3-year projections of what they think they'll earn, 3 years out. I honestly, for any company, I'd rather have details on the past 30 years of their history and financial history and stuff than I would what management thinks the next 3 years will be like.
Yeah, but
because all their competitors are also planning for the next 3 years too and stuff.
And I thought it was an interesting business. I don't think I think they're really pretty much the only company doing what they're doing other than the airlines themselves.
Yeah. We talked a lot about this one before I actually wrote it up.
Yeah.
Because I think this one's a very hard business to understand exactly what they're doing.
And the way that they, I guess, put up, or they have the obligations for the airline miles and stuff with the companies.
Yes, because
it's probably easy for them to forecast that growth. So
look here, the key thing to this whole. See, I didn't see this. You picked this before I saw this, but on Quick FS, the key thing is the last row, return on invested capital. Yeah. It's negative every single year. Or almost every single year, which means that they're not investing any capital in the business. So that makes it very interesting.
And they generate float. So it was just
they have to be generating float. Yeah,
it was just something. I was interested in the numbers. The business sounded quite unique. I could tell it was a service business of some sort, capital light. You look at the return on invested capital; it's negative, and they're earning. I think he uses operating profit for his return on invested capital. So to your point, they have negative capital. So it just from the offside, it all looked pretty interesting. And then EV to free cash flow was 8 times, 12% free cash flow yield, and it's growing a lot. So I thought it was interesting. And it's a microcap. $191 million market cap. And I can't remember. I think the shares don't even turn over 100% a year.
They don't. Yeah.
I think if I'm remembering correctly, the beta was more than one.
Beta was more than one, yeah.
So we're just.
Was it for Points International?
I thought so. I can't remember.
Game Host definitely was. I don't remember if Points International was.
But, from the outside looking in, it looked like something we'd be potentially interested to learn about.
It's definitely an overlooked stock. Yeah.
Good business, trading at a price that would be interesting to, do research on. And I was definitely interested in learning about it myself. I have airline miles. I have, American Airlines cards and stuff like that. Card, not plural, card. So I just thought it would be interesting to look at. But again, I think when I'm looking for different companies, the first thing I'm trying to mitigate against is the headline risk. And
but this company gets, I would say, all their profit from 12 airlines. That's my best guess. The company doesn't.
They say they work with like 30 something.
They work with 60 something, but
but
only about 30 of them do they really do anything that I think makes them profits. And I think that it's only meaningful in about 12 of them.
Yeah.
But, yeah.
So no, I just thought it was an interesting business to learn about. Looked good on the numbers. I think you liked the business itself. I think you get 80% initial interest.
Did I only give it 80?
What was it, 90?
I thought
it was high. It was one of the highest.
High, but just so people, go to the website, read the actual write-up.
FocusCompounding.com.
Maybe we'll talk about this in like a podcast where we talk about the write-ups. But of all the stocks we're going to talk about here, by far, Points International was the one that was the most interesting to me. Yeah. Capital class is very high actually too. But Points International.
So summarizing, it's a microcap. It's overlooked. High returns. Customer, high retention rate. Presumably
infinite returns on capital, and the company tells you they're going to grow over the next few years.
I don't think they have debt.
No.
So
they have cash on hand every day. That's very significant because of the
generates float.
We won't get into all that, but because of their timing, they're getting paid. They're getting paid basically from you buying stuff on your credit card. The credit card companies pay them within a couple days, and the airlines don't pay them for about a month and a half. Yeah. So they don't pay the airlines for about a month and a half for the points.
This business was hard to figure out. I felt like though.
I think until you read the report, you couldn't understand it. I don't think that the presentation does a great job of it. I don't think most of the write-ups that I read do a great job of it. The actual regulatory filings, they have regulatory filings in both countries too. They have them in Canada, where very few of their shares trade, but they are a Canadian company, and then also because they're on NASDAQ, they do have it in the U.S. It's not a 10K, but they do also have a filing there. And because probably rules are a little different in the two countries, there are slight language differences, not in the sense of English and French, but there are slight differences in terms of the actual wording they use and some stuff they add to the U.S. stuff that was interesting too. So reading both of them together, the U.S. and the Canadian regulatory filings, is how I based everything on what I think the company really does.
Yeah. So I thought it was interesting, and you thought it was as well.
Yeah, and I didn't have high hopes for it when I first heard about it from you. Yeah, it's only after reading those filings that I got excited about it. Yeah.
Cool. Okay, let's go to what do we got next? All these are on FocusCompounding.com. Go to Focus Compounding, and you can read them. Stella Jones,
another Canadian company.
That's
not really Canadian. Vitreous Glass is really a Canadian company. Stella Jones is about 2/3 U.S., 1/3 Canada, and Points International is really it's U.S. and Europe, but it's heavily U.S. really.
Yeah, let me pull it up on.
The employees are in Canada, but the customers are in the U.S.
Stella Jones. Mm-hmm. Okay. So Jeff's title for this company: long-term contracts selling utility poles and railroad ties, add up to a predictable, consistent compounder that unfortunately has to use debt to beat the market. Yeah. Unfortunately. Okay, so Stella Jones, I thought it was interesting. I think when I read the business description of them putting in utility poles, they do talk about their long-term contracts in their annual report or their 10K, which was something that stood out to me. The act of installing utility poles I thought was kind of interesting. It seems like a more predictable business. It is a very predictable business. Looking at the 10-year CAGR of 19% definitely stood out to me. If I remember right, do they roll up companies a lot?
Yes.
So they do roll up.
There's one line here that stood out to me completely, which is the second to last one. If you just read the return on equity number for a few years there.
Read it.
Okay.
I can't see from this far.
All right. So 18%, 15%, 18, 18, 18, 18, 16, 16, and then we have the most recent year is like 12. But that's really interesting and unusual. And I can also see because of the assets and the leverage things and stuff that's not due to any leverage changing either. So they throughout their business they have very, very consistent numbers. Now, when you learn about the business, you understand why that is because of pricing stuff that they do. But that's incredibly impressive because normally when a company has numbers like that, it's paying out its dividends and stuff. So it's like not retaining capital. But this business grows constantly. It's quintupled in the last 10 years in terms of revenue and stuff like that. So to grow at that rate, like this is, we're talking about like double-digit percentage growth in revenue, assets, everything, EPS. Doing that at basically the same rate as the return on equity, they've barely paid out any capital, is they're doing something that as they grow is the same economics as whatever they were doing before, which is really interesting.
Yeah, and when I came across it, I think it was only trading at 16 times earnings, and EPS 10-year CAGR is 13%. But upon actually learning about the business a little bit, and they're in the utility pole installing business and railroad ties. Quite honestly, I thought this is a company that Buffett would be interested in. That is literally exactly
pressure treated wood
and long-term contracts. I literally thought this is probably a company that Buffett would be interested in.
Berkshire buying this.
So I mean, let's learn about it, and that's the honest truth on why I was interested in it. And it's an overlooked stock, $2.5 billion market cap, but again, that has nothing to do with the overlookedness of it. And I just thought it was interesting. Very high returning, company. 10-year median margins on return on equity, 17%. So I just thought it was interesting to learn about. And again, I mean, I like businesses where, like we've spoken about GraphTech before, and we did a snap judgment on that. I read the write-up from an individual that wrote up a great report.
Yeah.
And I just, after I read it up, I literally was like, I have no idea what I just read. I have no idea about it.
Because it went into the...
I don't know what Coke needle is.
Yeah,
I don't know what graph... I literally was like, I have no idea what I just read.
Right.
So, I mean, for me to be interested in an idea, I feel like, and I always talk about this, I need to see it from the customer's perspective. I mean, I was just doing research on Hollywood Bowl. And I've bowled before, and it's an interesting industry. So I was like, let's learn about it. Monarch Cement. I know what cement is. Points International, as I said, I'm a customer of American Airlines Points and stuff like that. I know what that is. So it's very hard for me to get interested in an idea if I just visually can't picture it. And, Stella Jones, for example, railroad ties and utility poles. Obviously, you see those everywhere. It was something that I just thought was very interesting. And the numbers looked interesting from looking, sort of from the outside. And upon reading about it a little bit more, I thought it was a company that Berkshire would definitely be interested in.
Yeah, at the right price, this is something Berkshire
totally.
would buy, yeah.
So I thought let's learn about it. Yeah.
Yeah, my only reservation, so just so people know of why this doesn't raise highly some other things, price, because it includes debt and stuff, is pretty high. Like, EV to EBITDA, this is saying is 13 or something. That's not a deal breaker, but it's not super cheap. And the issue is that they can never earn super high returns on capital because unfortunately, the wood takes that you actually have to have logs sitting out for 9 months. And obviously you've already paid for them, so you're tying up a huge amount in inventory, and you have to finance that, and it's basically you finance it with financial debt, which is kind of an expensive way to finance that for 9 months. So that's the only issue. It's kind of like the opposite of having float or something. They have to tie up a huge amount in actually aging the wood and stuff. So
yeah. Okay. Let's see. What is going on? Okay, Game Host, let's talk about Sydney Airport.
Okay,
Sydney Airport, this is really a company that I was very interested to learn about because, again, from a customer standpoint, I've been in an airport, and I'd be interested in learning about, the economics behind them. Why is it so highly levered? That seems like a business that you could put a ton of leverage on. Think of all the foot traffic that goes in. Like I said, I've been in an airport. I've been a customer in, I guess, the convenience stores in an airport, if you want to call them convenience stores. So it was something that I just thought was very interesting to learn about. And I wanted to, I figured that's a business that you would be interested in learning a little bit more about. That company, to be fair, was already on your watch list that you haven't written up for the website.
Because it's been suggested to me by someone else.
Yeah. So I just thought it was interesting. Never have looked at the economics of an airport before, so I was curious to see what your thoughts were.
So it was
on
picked mostly by the industry, what industry it was in.
That one very much so.
Is the business model usually a big part of it, the industry?
Yeah, definitely. No, it is. Like I said, I like service businesses and stuff like that a lot, but really this was the industry, and I was curious. A business that could successfully operate with 7 times EV to EBITDA or debt to EBITDA. It's business that I just would be curious to see why.
So what are some of the ideas that
they have pricing, they have price increases and stuff like that, So it had, I guess from the outside looking in, it looked like something that could be potentially interesting What were your question?
Yeah. So what are the businesses you see and don't pass on to me? What do they look like? What do the runner-ups look like?
Yeah, that's a good question. I don't even know. I mean, usually the financials are very messy. They're not.
You didn't pass on Badger Daylighting to me.
No, Badger Daylighting I did not.
And that was probably a fast-growing faster than Stella Jones.
I mean, I'd still be very interested to hear your thoughts on it.
Okay.
I read the annual report on it. That's a company that would be interesting. It's another Canadian company. We got to change the screens up a little bit.
There's no rule against those investments.
No, I'm trying to think of other companies that I've looked at that I did not pass on to you. I mean, 1-800-Flowers. You haven't read that up for the website.
All right,
we talked a little bit about that. I looked at a chocolate company. I can't remember the name right now.
It wasn't Rocky Mountain Chocolate Factory?
It was Rocky Mountain, actually.
Which the franchises it.
Yep, franchises it.
That one you have to go to and see what one. Have you been in one before?
No.
Yeah, that would be necessary.
I've looked at Nathan's Hot Dogs, which we've also talked about on the podcast, but I didn't pass that on to you. Really, I'm just looking for businesses where I think the price needs to be potentially right. And again, I'm looking from a bird's eye view. So who knows?
But that is part of it. Nathan's and
are very expensive.
Isn't that cheap compared to like growth and stuff. Yeah. Franchise things tend to be pretty expensive.
Yeah.
So is it better not to look at the price? Is there some limit where you go, okay, well, 30 times earnings is too much, but 20 is okay?
Yeah, I mean, look, these companies I still pass on, they're trading 17, 18 times earnings.
Okay.
Which, I mean, your rule of thumb is you don't want to pay more than 13 times.
What I think the normal earnings are.
Normal after-tax earnings. But I mean, these companies that are growing and are good businesses, I mean, those are potentially just interesting to learn about. And again, I'm trying to build a watch list. I mean, literally on this Excel spreadsheet that I keep, I have I'll input a revisit price, and then I'll have another column for trading close to its 52-week low. I don't know why I do that. I just do it, and then it puts it to the top of the spreadsheet if it's either close to our revisit price or near its 52-week low. I'm just trying to build a spreadsheet of just solid businesses that aren't trading 50 times earnings.
Okay.
Ones that we could actually potentially own. I passed on a company that you haven't written up on the website, and I haven't even done a lot of research on it. I know you haven't either. It's an IT business in India.
Okay.
And they're like a service business. They remind me a lot of CSVI. Okay. And the stock's gone nowhere but down, but the revenue's gone nowhere but up, and free cash flow's gone nowhere but up.
Doing IT stuff for financial services.
Yeah, I think I actually read up the write-up on Vic. I think it's trading like 18% free cash flow yield, 20% free cash flow yield.
You don't generally find ideas from Value Investors Club, from Corner Berkshire and Fairfax. You said, you asked me once if I'd ever find an idea from Corner Berkshire and Fairfax, and I said I found one. And Charlie Munger said he read Barron's for whatever decades and found one idea.
Corner Berkshire and Fairfax, it kind of just I think I would get lost in the drama.
Would you?
I think so. Yeah, I really would. I mean, it's more entertaining than anything, but it's cool because it is. It's a cool website. I really do like it. But this IT or this Indian services company where it reminded me a lot of CSVI.
Okay.
That's what they do. They handle like the back end for banks and stuff in India, and 18%, 20% free cash flow yield. Revenue's gone nowhere but up. Stock's gone nowhere but down. I believe they don't have any debt. If I am remembering correctly, management owns maybe a huge chunk of the company. Again, those are all qualities of things that, it's just interesting to take a look at. And then the pattern recognition of really liking CSVI, core processing for the banking industry. It's a very predictable business, high customer retention rates. It just fits the mold of everything that we'd be interested in. So I was like, hey, this could be interesting to take a look at. And we don't know if we could even buy it. We don't know. We've been doing a lot of research on
that because of laws in India.
Yeah, so it's like, I don't know, but that's something that we'd be interested in.
Yeah, but like even Stella Jones, they serve customers that are very predictable, the same way that CSVI serves customers.
And what they're doing, I mean, the product itself, I mean, we're probably, look, 10, 15, 20 years, are we still going to have utility poles? Probably.
Well, yeah, because they last about 60 years. So you're not going to knock them down to replace them with something more expensive.
Yeah, sure. Yeah. So, I just thought it was interesting. And again, like I said, I mean, the numbers looked interesting. It was a company that I could visually, see the need for it. And I truly thought it was a company that Berkshire would be interested in. So I thought, why not learn about it? Numbers looked great. Trading only 17 times earnings, growing a ton. Look, if you have a company that can grow 18%, per year for the next 10 years, and it's trading at 17 times earnings, that screams cheap.
Yep.
So, I just thought, why not learn about it?
So you're going to keep picking stocks, and I'm going to keep writing them up at Focus Compounding?
Yes, focusedcompounding.com. So why don't you do the outro for everybody?
I have no idea what the
I want to thank everybody so much for tuning in today with Mr. Geoff and myself. A little bit different podcast of me talking about ideas. I don't know how much input I gave, but at the end of the day, I'm just looking for good companies, ones that we could potentially own, interesting companies. I like businesses where I can physically be the customer and like see the product. You know what I'm saying? When I was reading Graph Tech, my mind just went elsewhere. I was not interested in it. I have to be interested in the idea to potentially, do a lot more due diligence on it. So I want to thank everybody so much for tuning in with Geoff and myself. If you are on YouTube, hit that subscribe button, thumbs this video up, leave us a rating review. It goes a very long way. If you want to get access to all of these write-ups, go to focuscompounding.com. Geoff writes a lot of ideas there. So definitely check that out. I want to thank everybody so much for tuning in. We will see you in the next podcast. Take care. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.